goes. I'm not sure if we have a format for that, if people are going to type in a chat box but I encourage questions because questions are always coming up regarding credit anyway. So when people have them, I'm not sure if you're going to be able to see them, Roy, and then maybe if you can just let me know what those are because I
Yep.
can't see the chat box right now. Okay, perfect. So let me first describe or tell you a little bit about me. There's a lot of self-proclaimed credit experts out there that throw all this knowledge at people, and frankly, a lot of it is just not correct. There's a lot of misinformation on the internet. So I like this start, especially when you hear about credit repair companies too. I take a different approach to this. And so I think it's always good to understand my background in how I'm approaching it. So I've been in credit related industries for 30 years. I used to run some of the biggest car dealerships in the Chicago area for 12 years. I was a mortgage broker and owned a mortgage company for 8 years following that. And I started Illinois Credit Services in 2009, really to fill that void of people needing help with their credit, but not knowing where to turn. And so I took more of an educational approach to how credit works. I just think that people here, credit's not going away. So people need to understand how this works. And the common denominator is it didn't matter what your education level is, what your, where you live geographically, or any of that information. They just don't teach it to anyone. But I do teach 3 classes on credit and credit scoring at the College of DuPage. I have been hired as a credit expert witness. I've been on multiple radio shows, on the news, had several articles written from CNBC about me recently. So the point is that we take the high road when it comes to this, and the education that I'm going to share today is the correct answers if you're hearing other contradictory things out in the industry. So this happens all the time. People might go to a car dealership and see their score. They might hear their score is 512. They see their credit card statement. It says your FICO score is 618. Someone pulls their mortgage scores and it's a 561. They check Experience 627 and Credit Karma says 644. Now, the point is, the scores are all over the place. This is very confusing, and this happens all the time for people. And I'm sure you've seen it as well, Roy, where people say, hey, my Credit Karma says this, and then the credit report gets pulled and the scores are very, very different, and no one ever really understands why. Well, what people aren't told is that there's not one credit score for each of the reports. There's 3 credit bureaus, right? There's TransUnion, there's Experian, and there's Equifax. There are other consumer credit reporting agencies. Those are the 3 big players that people really need to pay attention to, though. No matter who gets the credit report or who obtains it, whether it's the car dealership, mortgage company, you yourself as the consumer request your credit report, the report itself is coming from those 3 credit bureaus. Now, they don't come with a credit score. Credit scores are put on credit reports as they're accessed. So what happens is this: if a consumer applies for a mortgage, the credit reports are accessed from the credit bureaus, and instantaneously, the reports are filtered through a scoring model that's called a mortgage FICO score. And it is a scoring model that's going to produce a number. It's a FICO score, but it's a mortgage FICO score, and it's only used in mortgage lending. You can't get it anywhere else. In no other industry uses it. If that consumer was at the car dealership, let's assume they're there at the same exact time, just because, let's assume the credit report isn't different because they're always changing, they're dynamic. But let's assume that the reports are exactly the same. The car dealership's going to pull the credit reports through a scoring model that's called an automobile FICO scoring model. It is a FICO score, but it's an automobile FICO score. It is different than the mortgage scores. And it is going to produce an absolutely different number than what the mortgage company said the FICO score were. Same thing for credit cards. They use a system called a bank card FICO score. There's insurance FICO scores. There's collection FICO scores. Right now, there are about, I think it's 56 different FICO models that are out there in the market. And none of them are wrong. In fact, they're all correct. It's just, there's only one that matters. And that depends on what the consumer is trying to do at that moment. Meaning, if they're trying to get a car, the only score that really matters is the automobile score. It doesn't matter what the mortgage score is. Vice versa, if you're trying to get a mortgage, the mortgage scores matter at that point. It doesn't matter what Credit Karma says or anything like that. So all the scores are directionally accurate, meaning that if you have problems on your credit, you're going to have all your scores are going to tend to be low. Whoop. Hello?
You're good. You're good.
Okay. You're going to tend to have lower scores if you have problems on your credit. You tend to have higher scores if all your scores or if the content is good. So I wanted to show this as an example of how different these scores can be. This is my daughter's credit report. It's redacted, of course. This was shared from a car dealership when she was purchasing a car. She was 19 years old. It's one credit report. It's a TransUnion credit report from the car dealership. And if you notice the circle on the bottom there, it's circling two numbers, two credit scores. One is a 668 and one's an 844. That's because this car dealership ran one credit report through two different FICO scores. If you notice, one's called a FICO Auto Score 8. The other one's called a FICO Auto Score 4. The same report, same day, produced substantially different credit scores. It's 176 points difference. Now, there's reasons for that.
So that's even within the same industry. That's within the auto industry. It's not.
Yes, they're both auto scores. Yes, okay. Because different industries also have different models that they can use, they can choose, except for the mortgage industry. And we're going to cover that a little bit more. The mortgage industry is kind of stuck in this box from a legal perspective at the direction of Fannie and Freddie. But auto scores, they can use multiple different FICO models, but they're all auto FICO scores. So I just wanted to show this as an example of how extreme one score can be from the other. Because a lot of people say, hey, what's your FICO score? You know, when people ask me what my FICO score is, my answer is, which FICO model are you referring to? Because that's really the answer. You have to, because they can be very different. So this is a really important thing to know. What does the scores mean? Because what everybody thinks, or most people think, and again, consumers have to just kind of figure this stuff out based on, whatever they think is right or wrong. Most people think that a credit score is identifying what they've done in the past. It's a grade of past performance, and that is actually not true. I'm not saying that the things in the past don't matter. They absolutely do. But here's the thing. Credit scores are a prediction of something you're going to do in the future. Okay. Now there's different models. There's different besides FICO. Most of what I'm referring to in this conversation is going to be referred to FICO scores, unless I specifically say it's something else. These are FICO scores. FICO scores are predicting the likelihood that a consumer is going to go 90 days or more delinquent within the next 24 months on one of their obligations. Okay. Now, if you understand that, it starts to make a little more sense why there's different industry scores, because there's a different likelihood. There's a different likelihood of a consumer being late on a credit card versus going late on a mortgage, right? They're different obligations. They're different levels of risk. And that's why there's different FICO models for each different industry. Wow. So yeah, what's that?
That makes sense. Yeah, so shorter term loan may have a different model versus a 30-year mortgage, which is going to have, they're predicting what's going to happen in the next 30 years is the idea.
Well, the next 24 months is how it's defined. Yeah. So the day that they pull your credit report, the scoring model, whatever model it is analyzing everything on your credit report. Do you have any late payments? Do you have anything good or bad? And then they try to figure out what the trend is going to be in the future. And here's the reason why it's set up that way. It's set up that way because credit scores were not created for you and I and this group to be discussing credit scores. They were designed to help lenders make a decision on whether or not they want to extend credit to someone. They're trying to help them assess risk. And lenders don't really necessarily come right out and say this, but they care about one thing. If I lend you money, are you going to pay me back, right? So the past tends to predict the future, but they already can see who you paid or didn't pay in the past. They're trying to figure out, if I give you money, what's the likelihood you're going to give it back to me? And that's why it's predictive risk. And let's face it, there are people that will never miss a car payment because you can't take my wheels, but and they might let their credit cards go. There's other people that will never, never miss a credit card payment, but they don't, so people, they have different behaviors, and that's what they're trying to figure out with these credit scores. So scores range in for FICO typically from 300 to 850. Higher the credit score, the less odds of a default. So now that we have this basic understanding about credit scores, and if we have time later, I have a lot of slides where we can talk specifically more about what goes into those scores and how to improve those scores. But right now that we have a basic understanding of how credit works, I wanted to transition into the CARES Act, because this is a big deal right now with the economy where it is and people out of work, making less money, and and now all these opportunities to skip payments, and how that's going to actually impact their credit. Now, here, no one in the government and lenders aren't trying to hurt people, right? They're trying to help people, and they're putting things together in a really, really quick fashion. I mean, this law, this CARES Act, that $2 trillion or $2.3 trillion, whatever it is, this is legislation that was passed in about a 2 to 3 week period, something historically short. Typically, it takes years for legislation to become a law, but they had to throw it together pretty quick. And there's no intention of hurting anyone, but there may be some unintended consequences too. And because there's a lot of players, from the law to the lenders to the servicers. So I want to talk specifically about how the CARES Act refers to credit. Now, there's the CARES Act basically amends the Fair Credit Reporting Act. It's a temporary amendment. The Fair Credit Reporting Act, it was actually written in 1970. It's 50 years old this year. It hasn't changed. There's been some amendments, but this CARES Act is the only amendment that's actually a temporary amendment to cover this period of this disaster, declared disaster that we're in. But the bottom line is people just can't skip their payments based on this law. Okay. They can't tell their lender, hey, I saw on, CNBC or Fox that I don't have to pay my payments. So they just skip the payments. The only way that you have any relief through the CARES Act is you must have what's called an accommodation from your lender. That's basically an agreement that they are allowing you to skip a payment, defer payments, pay partial payment, whatever it is, it must be communicated with your lender. I can't stress that enough. People need, if you're planning on skipping a payment or you need to skip a payment, you must communicate it and get permission from your lender.
Yeah, I think that's a huge key point, because a lot of people are seeing on the news and that, well, I get to skip my payments, and there's a lot of misconception about, oh yeah, just skip your payments, rather than calling your individual lender and work, making sure you work that out. And I know one of the big issues with the CARES Act on our side, as far as lenders, is how does this affect things in the future? But then as far as our sale of loans, so when we close a loan, we sell it to the servicer picks that up. If somebody goes into this forbearance, the servicer still has to pay the bondholder those monthly payments and the escrows and everything. So that's where we're having some issues on our end, is it could affect lending for the near future, because you've got a bunch of servicers that have all, millions of dollars worth of monthly payments that they may have to start picking up temporarily while these accommodations made. And I wonder if anybody spoke with the servicers before doing this, but like you said, it was kind of.
Well, now they're talking about possibly trying to help bail out or fund this debt problem that the services are going to have, because that's the bond. And we're going to talk specifically a little more about deferments versus forbearance and things like that, and how that gets reported. But the bottom line is exactly what you're saying is, and a lot of people the consumers don't necessarily understand this, but there's a servicer that services the loan, collects the payments, but there's an investor, the Wall Street people, whoever owns the mortgage, that's a different entity. When you pay the payment to the servicer pays the investor. Well, during this accommodation period where you're skipping payments, deferring, whatever it may be, if you're not paying the servicer still has a legal obligation to make payments to the end investor. Whether they're collecting the money or not, they are on the hook to the investor. They must pay that. So if you get people that are skipping 3 months payments, 6 months payments, they have the right to do an accommodation out to 12 months. If you have, hundreds of thousands, possibly millions of people skipping payments, that is an extremely big burden on the servicers financially to front that money to the end investors, and taxes and insurance and everything else too. So what the bottom line is, I don't feel that people should, some people are just going to do this because they have the opportunity to do it. They should not though. They must do what's called a test or a firm or hardship. This is the only, they don't have here. People don't have to prove this, by the way. It's a click of a button in some cases where you just check the button that says, hey, I have financial hardship based on the coronavirus pandemic. Or just, it's a simple question. Back in 2008, when we had the mortgage meltdown, it was different. You had to prove you had hardship. And then it was, that information was analyzed by the lender in modifications or during the HAMP program. They were either approved or not approved. But here, you just say you have hardship and you're automatically in the program. So people should really think hard before they do this, and only take advantage of it if it's necessary. And certainly people are in positions where they need to do this. So let's talk about how it's going to report to the credit bureaus. The way that if you're in an accommodation where you're skipping payments, the way the CARES Act reads is that they will report you on time during that period where you're not making payments if you are on time going into the accommodation. So if you're okay making your payments and you contact your lender and say, hey, I need some help, I've been impacted, and they say, okay, fine, we're going to have you skip the next 3 months payments or 6 month payments or whatever it is. If you are on time going into that, they're going to continue to report you on time during that time period. However, if you were late going into that accommodation period, then they are going to continue to report you late during that time period. So it's kind of one of those things. If you're good going in, you'll remain good. If you were in a difficult position or behind, you're going to continue to be behind. Now, when I say the 30-day window, what I mean by that is you're not late as far as credit reporting goes the day that you're late on your payments. Meaning if your mortgage payment is due April 1st and we're at the 10th right now, you are not late for credit reporting purposes right now. Credit reporting considers you on time until you are 30 days past due, past your payment date. Okay. That's important to know, but it's a window where you can work these things out, contact your lender. Your credit report. I mean, really, if you paid your payment up to 29 days before the 30th day, it's still considered on time for credit reporting purposes. I'm not trying to encourage people to do that. No. That is a very, very slippery slope. And a lot of things in the credit reporting world, especially with this accommodation program or the CARES Act, you have to get permission. You can't ask for forgiveness. So you can't just skip payments and say, hey, I was on hold for 4 hours and I couldn't get through to you. So I hung up, and I know everybody's doing this. So I just figured I could talk to you, 4 months down the line and just make sure you report me on time. You can't ask for forgiveness after the fact. You must do it up front. Okay. They're not allowed to charge you any fees either for this, meaning it's only your payments that you owe, right? Principal, interest, taxes, and insurance, any of those things. They can't add a fee, and nor have I heard anything that they're trying to do that, but just so the consumers are aware, there's not a cost to this necessarily. Now, we talked about how it's reported because there's payment history that's reported, the timeliness of the payment. Here's something that I want to talk about, which you kind of mentioned, Roy, about how this could impact things down the line. There's everything with a credit report is coding, right? It's the raw data at the credit bureau level if someone saw that data, they would not be able to make sense of it. It wouldn't look like, it wouldn't be words. It's all codes. It's numbers, letters, and it's all back end coding. And then when they compile the credit report, it gets put into a readable format that as consumers or lenders, we can look at this. So there's a category called special comment codes. And some of you may have seen this where you'll see a comment that says included in bankruptcy, or settled for less than full balance, something along those lines. It's a code that produces a narrative on that trade line. Well, there's coding for disasters. There's natural disasters and declared disasters. It's called the AW code. People won't ever see the AW code, but it's submitted by the lender to the credit bureaus, and then they put this special comment code on there. Now, natural disaster, I mean, typically the only time you see that is when you see a hurricane. You see, or there's a tornado, something, natural disasters. And that does happen. That's also in an isolated part of the country, right? It's usually one area. But this is the one time that it's actually a declared disaster. This is not a natural disaster. The president declared a disaster, and it's countrywide, so it's affecting everyone. Now, the credit bureaus can have a code put on there that says the account's in the declared disaster. They can also put another one on there that says the account is in forbearance, because if someone enters into a forbearance agreement, even if they're reporting the payments on time, the lender may report account in forbearance, because one of those two things is happening. If you're in this accommodation program, then the lender is being instructed to code it one of these two ways. Well, the problem with that is when lenders are coming back later on down the line and assessing risk, they're going to look at that and say, okay, you claimed hardship. So there may be some risk concerns that a lender may have if they see that, well, you had a claim forbearance. Yes, we know it was because of, the pandemic, but you were in a hardship situation, and that may cause some lenders to pull the reins back a little bit or be a little more conservative when they're assessing risk. I'm not sure if you've seen that if forbearance has ever been an issue, if you've seen that in the lending side of things.
No, just when we went through, the real estate crash, the people that went into modifications, there was, lenders put a timeline from, a certain amount of time from that modification before they would do a refinance or do another loan for somebody. So
right, because when it says, I forgot the terminology for that code, but it was modification, call it, but account included in modification, something along those lines.
Yeah.
That's a red flag, right? And it causes concern, and these could very well do that. And that's one of these possible unintended consequences that may down the line be a concern for a lender. But again, if people are in a situation where they have to do this, they have to do this anyway. But it's something that people should at least be aware of. Now, when those codes are put on a credit report, how does FICO treat those codes? And the answer is it doesn't. For a FICO score, if it says, now this is different. If you see an account that says settled for less than full balance, that is factored into a FICO score as an adverse comment. A declared disaster or account in forbearance is not part of a FICO score. It is cosmetic only. It doesn't impact the scores whatsoever. Okay.
Okay.
However, I want to bring this up because there's a lot of people out there that have Credit Karma accounts or other monitoring accounts, right?
Not my favorite things, let me tell you.
Yeah.
And
by the, it's the argument is it's free, right? Well, it's actually not free, by the way. It just doesn't cost you money. It costs you an exchange of your information. So you're agreeing that they're going to sell your information to a whole bunch of different credit card companies, insurance companies to solicit you for offers. So there's the value that they're getting out of it. So if you opt out of that and won't let them do that, they won't give you the Credit Karma account. But still, okay, it doesn't cost you money. But here's the problem when you have these codes on a Credit Karma account or any monitoring system that uses what's called a Vantage score. Vantage score is the big model. I'm not going to go too far down the road with Vantage scores because FICO is really the more relevant one when it comes to lending at this point. But Vantage score has their boots are on the ground and they're right behind FICO. And when you see a Credit Karma monitoring system, they're using a Vantage score. The difference of my point here is Vantage score, when it has one of these declared disaster codes, they will ignore any adverse history on that account. So let's say you have a 620 credit score going into this situation, and then you have the disaster codes. Your FICO score will still be 620 on the other side of all this. However, if you have a 620 and you have late payments on your mortgage and they put this disaster AW code on your mortgage, you could see your Credit Karma or your Vantage scores spike through the roof because any of the derogatory payment history on that mortgage is now going to be ignored. So that 620, people might be looking at their Credit Karma account and they could see their scores could be 700. And they might think that their scores overall improved, but it doesn't necessarily impact the FICO scores, if that makes sense. Okay, so let's talk about deferment versus forbearance. People are here. First of all, neither one of them is forgiveness. This is skipping a payment doesn't mean you don't owe the money. It's just
right,
a matter of
really skipping it. You're
no.
paying it at some point.
Yes, it's when and where you're going to pay it and how you're going to pay it. And from a consumer's perspective, there's a lot of things being, put on the news and a lot of people talking about, deferment and forbearance is very different. Okay. And people they don't know the difference. They just assume skipping is skipping. It's not. So let's talk about forbearance first, because this is the one that can be pretty scary for people. First off, in the CARES Act, a consumer can request forbearance if they claim and attest to hardship from the virus, from the pandemic, where you get up to a 6-month extension or 6 months of forbearance, and you can get another 6-month extension on top of that if you request it, for a total forbearance period of up to 12 months. Now, you don't have to take 6 months, but you can talk to your lender about that, but that it's available up to a year. Now, here's the problem with the forbearance is the devil's in the details. I cannot stress this enough. Besides contacting your lender, you must know exactly how they're going to want that money paid back at the end of the forbearance. A typical forbearance says, okay, we're going to let you skip payments now. You stop paying now and you skip 6 payments. In the 7th month, most forbearances are going to tell you, okay, the forbearance is over. We let you skip those. Now in the 7th month, you need to pay us all those payments. You need to pay the 6 payments that you skipped plus the 7th one that's due right now. That could be a financial disaster for people.
Right. I think that's where if people don't pay attention to what they're signing or what they're agreeing to, if you didn't have the payments for the 3 months, you're probably not going to have all 4 payments on the 4th month.
It's very unlikely, in my opinion. That's why they're skipping payments, because they don't have the money. And now again, I don't think that lenders are trying to put people in a bad position necessarily, but it's all these lenders and Congress and everybody's throwing this stuff together really quickly. And at the end of the day, these servicers, remember, the servicers are fronting the money. You're making an agreement with the servicer that you're paying. They're fronting the money and they're cash strapped right now. They want that money back because they're giving it they have to pay it to the investor. They do want to recover that as quickly as possible. So a servicer could just, not mention the fact that you have to pay it all back at the end of the forbearance period. And it could put people in a bad position. I've heard that there's different programs they're doing here. They might say, you might tell them, hey, I don't have that money. And they might say, okay, fine. Well, then what we'll do, you owe us $8,000 or whatever dollar amount it is. How about we do this? How about we come up with a program where you give us $300 a month for the next 24 months or 20, whatever the math is, and to play catch up. And that can be a problem for a consumer right there too. Or they may modify the loan. Or there is a possibility that in a forbearance, they could do what's called deferring the payments to the end of the loan. Now, that's the safest play for the consumer because they don't have to come up with the money until the very, very end then. And that's kind of what people are thinking. It's skipping payments meaning if, I have a 30-year mortgage, I skip a year's worth of payments. Now I have a 31-year mortgage. But the problem is it's in the details of whatever they're agreeing to. You just can't make assumptions about what you're agreeing to. You need to see it in writing and know exactly what it is, or you could be caught in a tough position.
Yeah, and I think that's the deferment, obviously, to the end of the loan is perfect. That's great for everybody, but how many servicers can afford to defer 8 months of payments? And then if you go into the loan modification, does that then show as a loan modification on credit? And how is that going to affect your future financing options?
Probably. I mean, right, exactly. Well, how is it going to play down the line when you want to get, score impact and then risk assessment impact for future loan applications? And here's the thing: lenders, by law, they have to report accurately. If you enter a modification, they have to report it's in a modification. Right. If you do a forbearance, they're supposed to report that. So, no one's trying to hurt people, but they have to follow laws and procedures. That's why the government with the CARES Act, they told the lenders, hey, you have to report them on time. Because if they didn't pass that law, every lender is obligated by law to report if you missed a payment, whether we let you do it or not. If you didn't pay the payment, then they're obligated by law to report that. But when they passed this law, that protected the consumer. So that's a good thing. So deferment, that's the word you want. That's the preferable program to be in. I've heard that Fannie and Freddie have a deferral program that they're doing as opposed to a forbearance program. There's so many servicers, so many lenders out there. And things are changing day to day. So what the key is knowing what you're getting into. Deferments start at 3 months, and I believe you can keep getting them for 3 months increments up to a year. And all payments are typically put to the end of the loan. It's not a forbearance where, hey, you pay me at the end of the term.
Now, when you say the end of the loan, that also is going, let's say I go to refinance 5 years from now, that's going to be an extra balance I have to refinance then, correct?
Sure. That's an unintended consequence that I think makes sense to people, but they're not really thinking about that. I mean, if you have a $2,000 payment and you skip a year's worth of payments, I mean, it's $24,000 that's tacked on that you basically stripped equity out of your house. People might be upside down on their houses or underwater again based on programs like this. Because again, it's not free. It's just deferred. And so people have to take these things all into consideration. They don't want to look at this and, again, people are going to need this help. There's people that are severely impacted, and that's what this program is for. It just, people, if they can make their payments, I feel that it's probably a better choice to try to do that just so you can avoid some of these unintended consequences. So, the one thing I wanted to talk about is what the term is, and then we'll talk about some of these final thoughts about the CARES Act. Are we getting any questions about the CARES Act, or anybody have anything they want to?
No, nothing. Nobody's popped in any questions.
Okay, that's fine. So there's a covered period of the CARES Act, and you can enter into these agreements anytime during the covered period. Now, the covered period is from the day that Trump signed this on March 27th, I believe it was. The covered period goes back to January 1st, and then it continues for 120 days after the date of March 27th when the CARES Act was signed, or the later date of whenever the declared disaster is terminated. So if it goes for 2 more months, it's going to be 120 days on top of the 2 more months. So that's what's that covered period that you can enter into these agreements. So here's the bottom line on this. People need to act early. They need, it's going to take a while to, these lenders are and servicers, they're swamped with phone calls. I mean, you have this many people calling a call center that can handle this many calls, and there's hold times could be hours. But regardless, you may check out their websites. Some of them, they have on their website a way to do it to avoid where it would be in writing then. But the bottom line is make sure that they're communicating some sort of way with their lender, and understand what the terms of the payback are, and always defer to the end if you have that choice.
Okay.
And again, these unintended consequences, escrow shortages are a possibility. I'm not sure if that's going to really play out as much, just because the servicer it has an obligation to pay those escrows out too, to pay the taxes, to pay the insurance. So again, this is more so than anything, this is a lot of pressure on the servicer, and that's something that the consumer is not seeing or really understanding how much of an impact that can actually have in the mortgage space in general.
Yeah, I've been on a couple of calls where they're talking about that part of that side of things, where it could impact your conventional pricing, your interest rates, because who wants to take on, I mean, it's already impacted FHA pricing with all the unemployment filings. You've got now lenders are or servicers are a little less apt to want to buy and service those loans, because it doesn't matter. I mean, you could be making $200,000 a year and a corporate executive. You could be furloughed or laid off or whatever at any point. So it's not just, I mean, it impacts lower income quite a bit as well, but it can affect anybody. And that's where you could have had perfect credit your whole life and something like this happens. And now you may have to jump into a forbearance, and that's risky for a servicer.
Sure. And even if it's not a matter of getting denied on a loan, let's say, the furloughs or anything like that, they're verifying employment right now much more aggressively than they ever did, because people that had, long time histories of being employed, as of last week, some of them aren't employed. And before those loans are purchased, they're going to verify employment again. And that's a problem, where they're sending these loans back to the originator and making them buy them back. And so anyway, it's
yeah, on that subject, we've actually started the day of closing. We're doing a verification of employment.
Right.
In the closing packet, there's a document you have to sign stating you're still employed the way you were, and you haven't noticed a drop or aren't aware of any drop off in income, etc. So and we've had a couple clients that have either had 20% cut in their income. Fortunately, they were still able to qualify for the loan, but for some people, a 20% drop in income means they're not going to qualify.
Right. And from a lender's perspective, I mean, you can't really blame them. They're trying to figure out who's a good risk and who's not, right? If somebody's not working, they're clearly a higher risk. If somebody attests to being financially impacted by this pandemic, then as a lender, that has to be a concern to them, because they're claiming financial hardship. So when they see that forbearance or disaster codes or anything like that, there's going to be cause for concern and looking twice. And again, I don't feel that you can blame lenders for that.
Right.